Hello, Board of Directors. My name is Nate Rogers, and I am an agent at Risk Manage Associates, and I've been assigned Ford Motor Company to look at your all's financial statements and to help guide you guys towards future success with telling you guys what's going on behind the scenes. All right, so first off, we're going to look at some liquidity ratios, and that's going to be your current ratio and your quick ratio. Your current ratio is your current assets divided by your current liabilities, and your quick one is the same thing minus inventory in the numerator. So, as you can see, both of these are above the industry standard, which we really like to see because that means your company is more liquid than normal. This is really nice for investors because it's a lower financial risk. They know what they're getting themselves into. They know they're gonna make money by investing in your stock. And it just tells us that you guys are less likely to fall back on debt in order to finance like unexpected expenses and stuff like that. However, our quick ratio here is climbing a little bit, and a really high quick ratio can be concerning down the road for investors because it can mean like inefficiency in the use of your all's assets, whether current or fixed, just inefficiency in getting those to be profitable. So, okay, next we're going to look at some efficiency ratios. This is going to be our fixed asset turnover and our total asset turnover. Now, if you can see, both of these ratios are much lower than what our industry standard is, and this could mean a couple of different things. Most of the time it means that we're just not using our equipment and our inventory efficiently in order to generate sales. This might mean like we have too many factories working on the same thing, or the equipment that we use to build our product is aging, stuff like that. When looking at these two ratios from an investor's standpoint, this could look good as like a long-term investment for experienced investors. But to the common investor that just looks at baseline things, they're not going to pick that up. So it's not great for the investing sense. And like I said, we just need to be more efficient in using our inventory to generate sales and stuff like that. So. Okay, moving on, we're going to look at some financial leverage ratios. In this is going to be our equity multiplier and then also our debt ratio. I want to look at our equity multiplier first. As you can see, it's almost 1.5 points higher than our industry standard. Higher equity multiplier just means that we have more financial leverage as a company. I kind of like this because it could in turn increase our return on equity, which means we're more profitable as a company. It also can provide for a larger asset base, which provides us more tools to like expand, build more factories, stuff like that, and just like grow the company as a whole. We also want to look at our debt ratio, however, which is quite a bit higher, almost 5% higher than the RMC value. This can be concerning to us as a board of directors and also as investors because it seems as though we use more of our debt to finance unexpected expenses than we normally should. This provides a more high financial risk, and it could be misleading to investors looking at it. Okay, next we're going to look at some interest expenses. We want to look at our times interest earned, and although this is almost half of what our industry standard is, we generally like to look at like a 2-point times industry earned. So we're still really in the green here. I like this because it just tells investors that we can meet our interest expense obligations, and when things pop up, we can pay those and just continue to be profitable. So I really like this. Okay, before we talk about our profitability ratios, which will be the last kind of category we'll talk about today, I just want to say that from an investor standpoint, we really like to see all of these ratios that we've talked about before. Whether or not they fluctuate between like higher or lower than the industry standard, every one of these is in the green and is what we look for when investing in a company that's going to make us a lot of money. Now, in saying that, as you can see, our profitability ratios meaning our profit margin, return on assets, and return on equity are all pretty significantly lower than the industry standard that we've set for ourselves, right? Now, because Ford is in the automotive industry, this normally doesn't scare me very much as an investor, right? And because Ford has such a high liquidity, this means that they can still pay off their like short-term debt as while having a low profit margin, which doesn't scare me in the slightest. We can contribute this low profitability and low return on inventory, return on assets, return on equity to the automotive industry as a whole. I mean, building a car takes a lot of different things. There's going to be high cost of goods sold everywhere, but because we sell such a high variety of products, the sales will still continue to come in, and we can still be profitable because of that. And yeah. Now, obviously, Ford Motor Company is one of the industry leaders in the automotive industry. So again, as an investor, I'm not too worried about looking at these specific ratios. Now, coming from a risk management consultant standpoint, we do want to focus in this next quarter on fixing our turnover ratios and becoming more efficient in using our assets and inventory and stuff like that. But overall, very good. Again, my name is Nate Rogers. Thank you guys for meeting with me today, and I will see you guys soon.